What is going on? Happy Tuesday to you. We are back. Welcome to Retirement Intel. I'm Jonathan Rankin. I'm your host. And today we're going to go through a lot of things when it comes to retirement planning. We're going to be talking about whether or not right now is the time that you should be selling within your equity portfolio if you're saving for retirement, because according to a recent article out of Morningstar, they're suggesting that now is the time that you should start selling. So we're going to go ahead and talk through that. We're also going to be talking about some retirement myths. There are always these rules of thumb and rules that you need to follow, or theories and all these different myths. But what should you be listening to? What should you be following? We're going to break that all down. We're also going to be talking about what is a fiduciary. This word's thrown around so much. There's a law that is out there called the Fiduciary Standard for IRA rollovers, and so we're going to be breaking that all down because there was a really recent article in the Wall Street Journal that kind of brought this up. So we're going to break all of that down. Make sure that you hit that subscribe button. I appreciate you being here. We do this every single week, Tuesdays at 4 p.m. Central Time. So welcome if this is your first time. If you've been here before, thanks for coming back. And yeah, let's go ahead and dive right in. So, the first thing that we've got to talk about, we've got to go through some of the latest things that are out right now. And when I think of, what's going on in the world, we got to say, first of all, the Olympics are over. And what that means to me, and for a lot of you, that means that football's coming up. Very excited about that. But can I just say that for the first time in the history of the Olympics that I've ever watched, was there actually an event where I thought, you know what, I could do that. And I could do that better than the athlete. And if you didn't see it, that was the Australian breakdancing. I really think that if I, actually attempted that, I too could be a part of the Olympics. So that was very fun to watch, and something where it actually gave me a little bit of, made me happy knowing that I could be an Olympic athlete, and so never thought that until now. So yeah, that was fun. But I'm happy that the Olympics are over, because I'm very happy that coming up, we've got football. And so just a couple weeks away. But where I want to start is, just a couple things that I've seen in the news, and something that we'll go through every single week is just some, recent headlines. And one of the most recent ones that I found that was pretty interesting was Costco is now going to be cracking down like Netflix. For years, when it came to Netflix, you can share your password with everybody, and now they're cracking down on that. Costco is going to be doing the exact same thing, and I thought this was kind of funny because I personally, for some reason, I don't know why, I've been a Costco member since I was 18 years old, and I will never get rid of that card. But I found it kind of interesting because now if you give that card to your kids, your grandkids, or whoever else, or someone to use it, that's going away. So you're not going to be able to do that anymore. There's also a very interesting new law that was just proposed, and I thought this was pretty interesting. When looking at subscription costs, there's finally something that's going to help us all save a little bit of money. And so there was a new law that is being put out there. Still isn't passed yet, but they're finally making a move to make canceling subscriptions a little easier. I don't know about you, but myself, and I know a lot of clients who go through this as well, where once you subscribe to something, it's so hard to figure out how do you actually cancel that. And if you've been watching this channel for a while, we've always talked about the car wash subscription. That is one thing that I don't know ever how to cancel that. And so the fact there's a new law that's coming out that's going to be making it easier for us to cancel subscriptions, this is going to save a lot of people a lot of money, and I'm very excited about this one. So I just had to share that, because to me, it's about time that we get something from White House that is on our side, that's going to help us out a little bit. So very excited about that. But we're going to go ahead and we're going to dig right into some of the big topics that we're going to be talking about today, and mainly really want to talk about whether right now is the time to de-risk. Last week we had one of the wildest days last Monday, where the VIX spiked up past 60, and the markets fell across the globe, all because of some Japanese yen carry trade that most people do not even care about. So we had this correction last week, and then now things have recovered back. But where do we stand? Where are we at? And is now the time that you should be selling, essentially? And when I came across this article from from Morningstar by a very well-respected journalist and someone in the in the actual personal finance community. Um, Go ahead and pull that up here. So her name is Christine Benz. She is written a lot of articles, a lot of different pieces within the retirement space, and very, very interesting stuff that she puts out. But right now, this headline really kind of grabbed me: why retirees and investors approaching retirement should reduce risk today. And is now the time that you should start running to your phone or your computer and hit the sell button, even though the market's closed, so it can go in tomorrow. That's not what this is about. It's really starting that conversation on whether or not right now is this a time to start de-risking. And so when I saw this article, I said it really got me thinking about what is going on right now. Why is right now the time to de-risk? What is Christine Benz talking about when it comes to now being the time to do that? And so the way she put it is that people within 5 years of retirement should use this time to de-risk. And she talked about how there was an article or a study that was produced by Vanguard, and what they showed is that the average 401k investor between the ages of 60 and 64 had an allocation of stocks at 60%. And when you compare that to either the 2030 fund or the 2025 fund, both of those funds had quite a bit less in stock exposure. So you think that 2030 fund, that's the target of when most people are going to be retiring. If you're investing in that fund, that's the whole purpose of it. That's why it's called a target date fund. And within that fund, if your goal is to retire in 6 years, based on that fund, you should be investing 52% in stocks. So what this is showing is that the average investor that's over the age of 60, between 60 and 64, has 8% more in stock exposure than they technically should. Now, is that the case? Well, why is that happening? Well, you look, okay, last decade, obviously stocks have done extremely well. Bonds, extremely disappointing, especially if you own bonds, in 2022. That was a year where for the longest period of time, everybody's always thought of bonds as being kind of the safe haven. And then 2022 was one of those years where, everything fell. Stocks fell, bonds fell, and you kind of throw your hands up and go, okay, I thought these bonds were supposed to save me. So now you've got this period of, a long period of time, well over 10 years, that stocks have outperformed bonds. Bonds have been disappointing, but is now the time to start reducing that. But let's talk about whether or not it's time to scale that back. Because scaling back stocks, and the risk in your portfolio, obviously it does have some benefits to it. You've got, it helps with sequence of returns. If you're thinking about retiring soon and we do go through some sort of market correction, then yeah, it's going to help, because now, if you've ever heard of sequence of return risk, what that says is that if you're taking withdrawals out of your portfolio and you experience even a minor loss of anywhere between 5 and 10% in your portfolio during those first initial years, it can cause you to run out of money a lot sooner than when you were initially expecting, because that first year started in a loss. So it does reduce that. But right now, the reason why I think, Christine in this article points to this being a really good time to reduce risk is because there's finally an alternative. Since 2009, when the Fed started dropping rates to zero and printing money, there really wasn't an alternative. Money markets were paying 0.5%. Bonds were paying, next to nothing. I mean, in 2022, the 10-year Treasury was 1.2%. And so, now, or I'm sorry, it was 1.7%. Now it's, getting close to 4. And so, you had really no alternative before to generate income. You now have the opportunity to lock in some good yields if you want to. And this helps prepare that cash flow. I look at this as a good time if you're thinking about doing it, because we're having the conversation when the stock market's near all-time highs. I've been doing this for quite some time. I went through 2007, 2008, and I remember conversations in late 2008, early 2009 about people wanting to de-risk at that time. I mean, even back to COVID or 2022, after the market's already fallen 15 or 20%, that's when people want to start de-risking. So that's probably the worst time to start that process. Now, if you're selling when the market's strong. Could it go higher? Yeah. And so that kind of leads us to, how should you be allocating? If you think about over the past 10 plus years, if stocks have done well and bonds have disappointed, well, if you've been just a passive investor and you've kind of set it and forget it, like we're baking a chicken here, and you haven't really looked at it, well, then the reality is your asset allocation has definitely changed. You might have set your initial asset allocation maybe at that 60-40, like most people think about when it comes to retirement. But if you've just set it at a 60-40 and you've never gone back to rebalance that, well, now it's probably close to 80% stocks and 20% bonds, because over the past 10 years, stocks have outperformed. And because of that, the asset allocation is out of whack. And that's where the problem is created. Because when we look at a year like 2008, if you were in a 60-40 portfolio in 2008, from peak to trough, you were down about 27%. And when you compare that to an 80-20 portfolio during that same time frame, the peak to trough during that period was about 40%. And so this goes into what can you stomach? There's no one size fits all asset allocation. Even if you want to retire in 6 years, you can, by all means, have more stocks if you can stomach the volatility. And if your retirement plan can stomach, any sort of bear market, if we do go through that, there's no one size fits all when it comes to, how to invest for retirement. And it kind of leads us to, so how do you go about deciding? How do you actually decide whether or not you should be reducing risk at this point? Is that something that you should actually do within your portfolio? And the way that I like to think about that is, are you okay with volatility? Are you okay if the market does go down 15, 20% from here and you've got to stomach that? Are you on the opposite side? Are you okay with missing out? Because most people, if they're getting close to retirement, they're going to say, well, no, Jonathan, I don't want my portfolio to go down 20%. I don't want to see that. Okay, well, are you okay missing out if you're wrong? If this market continues to rally and we continue, the Fed starts reducing rates and the stock market keeps going a lot higher, are you okay missing out on some of that performance? You've got to think about what's important to your investor behavior. How did you react? If you're thinking about retirement, my guess is you went through 2000 to 2002. You went through 2008. You went through COVID correction. You went through 2022. How did that affect you? What went through your mind during those periods of time? Did you make any knee-jerk reactions? Was it, the first reaction to go and start selling once the market already fell? Start thinking about how did you handle, from a personality standpoint, those previous corrections, and use that as your guideline. Because that's the one side where if you know yourself and you think back to 2008 and you did think, okay, the market's down 30%. I just want to hold on to what I have. Let me just start selling. Let me pull some of this back. If you did that, you probably did it at the wrong time. Let's not make that mistake again. Maybe now is the time to start shifting that. But really, it is going to be based on each individual. There's not going to be a one size fits all. And if you have questions on how you should be allocated, use that link in the description below. Schedule some time with a member of our team. We'll help walk you through a complimentary retirement analysis and help you understand whether or not you're allocated the way that you should be based on your long-term goals, because it's all individualized. And so, like I said, there's no one size fits all. But when we think about what's going on in the market today, volatility is obviously picking up. It's higher than it was, a couple months ago, and we've got an election coming around. We've got the market near all-time highs. It's a much better time to sell today than it was, or than it will be if the market does fall by 10% or 15 or 20%. At the same time, we finally have other things you can buy. Bonds are finally getting a decent yield. CDs, you can get yields, north of 5%. I mean, money markets, granted, that's more of a short-term investment. Even money markets, you can get, a decent yield right now. So there's alternatives, whereas there weren't before. And so now you have the opportunity to earn something outside of just investing in stocks. So, I know it's not easy to figure out, because there's always that fear of, well, if I'm wrong, if you're wrong and the market keeps going up, then what do you do? And so that's why I always say it's important to never have a strategy that you're all in or all out on. Always have something that's going to be, somewhat balanced, maybe tweak it here and there, do some rebalancing, but really personalize it to your individual goals. So hopefully that was helpful. I think she did a great job in her article, kind of laying out the rationale as to why this is a good time to sell. And so check that out. I linked to that in the description below. And so it's a great read. I think she does a really good job and someone really good to follow. So, now that we're going to kind of move past that selling time, there was another article within Morningstar that talked about retirement myths. They called them 6 retirement financial myths to avoid. And I see a lot of articles like this, and I always just question, okay, what does this mean? Why are we talking about all these different rules of thumb? And so I wanted to go through this list and go through it with you guys to just paint the picture and see, okay, are these things that are legitimate? Should you be following these guidelines? Should you be listening to these things? What should you be paying to? What really matters? So, the article was, once again, this one was also in Morningstar. And so, they go through a number of different ones. I'm not going to go through all 6 of these because there's other aspects, that I think we will cover that are, I don't want to go through all of them because some of them were pretty basic, but check out that article. I linked to that in the description below. But when we think about some of the different financial myths that are out there, the first one they talk about is that, I hear this one a lot, and this one I thought was very important to go through. It's, should you live off your income alone and not touch your principal? I see so many people that when they think about investing for retirement, they have this thought process of, well, as long as I invest my principal and I get X amount of, return, yield, you name it, I don't have to touch my principal, and that's going to sit there forever. That's great. Especially now, as we just talked about, you can finally get some sort of alternative to stocks. You've got treasuries that are getting, in the 4% range. You've got money markets that are getting in the 5% range, and CDs in the 5% range. But let's think about it like this. What is the issue with this strategy? Well, the issue is going to be inflation. And obviously we've dealt with a little bit of inflation over the past couple of years, so it's not something that's a new phenomenon. But they point to a really interesting things. If you invest your retirement savings in bonds that return a 4% per year income rate, in 5 years, you're going to still get $80,000 a year in income if you have $2 million. So let's say you invest $2 million in bonds, you're getting 4%, it's $80,000 a year that you're getting in income. But after, let's say, a 3% inflation rate, you almost need, at that point in 5 years from now, $93,000 to support your lifestyle. So yes, your income stream has stayed the same, but it doesn't account for that inflation aspect that stocks typically help with. We talked about it last week, how a lot of people think that gold is the number one performing asset to keep pace with inflation, when in reality, if you look at the actual data, it's actually US stocks. So it really does leave you with 2 choices if you go with that route of, I'm going to invest my money in bonds or CDs or money markets, and I'm not going to touch the principal. You can either reduce your expenses every year, which I don't think most people want to do, or it's going to eat into your principal. Now, you could invest in stocks, and I've seen and still not touch your principal, but then it goes to, well, are you only going to be selling in the good years? And if you are you going to be okay taking a pay cut in the bad years? Because as we know, stocks don't go up every single year. And so if that's the case, how are you actually going to, be able to manage that cash flow? If you're okay with flexibility and fluctuation in your cash flow, that's okay. But just thinking that, you're not going to have a safe retirement if you don't ever touch your principal it's a flawed thought process. It makes sense on paper, but when you actually start digging into the numbers and digging into an actual retirement plan, then you'll actually see that it's going to be beneficial to, have more of a total return portfolio over time. And, yes, that's going to, at times actually take out from the principal, but that's going to help you keep pace with inflation. Where I've seen most people, think that, come to me with this type of philosophy, most of them have not gone through an actual formal retirement planning process. And so if you haven't, if you're, putting things on Excel and you haven't really gone through an actual financial planning process, that's where we can absolutely help. So, I want to help, with that mindset around retirement, because retirement is all about a mindset. It's about a mindset of, being comfortable that you're going to leave whatever salary you've got or consistent pay you've got, and you're jumping off a cliff hoping that the savings and pensions and social security and everything that's going to be contributing to your lifestyle is going to be able to catch you on the other end. So yeah, it's a scary moment. You've got to have, confidence in that decision. And so that's why we always say start planning as early as possible. Now, the next myth that they talk about is that you need to hold bonds in percentage that equals your age. So if you're 75 years old, you should have 75% in bonds. If you're, 25 years old, you need to have 25%. I don't like rules of thumb like this. There is no one size fits all. I've got, I know people that have 100% in stocks. I know people who have 100% in bonds, and they're just lifestyles are completely different, and they're in different stages of life. If you think of, if you are, 80%, you're 80 years old and you've got 80% of your, your money in bonds, but let's say you don't need all that money, and you want to start thinking about your legacy, and you want your legacy to grow because that money is going to be for the next generation. That's where rules of thumb like this fail, is that they're thinking about your lifestyle and your lifetime. They're not thinking that some of this money might be for your kids or your grandkids, or, it's so when you think through that part of it, that's where you have to rethink what is your time horizon on those dollars. If those dollars aren't going to be spent by you, but spent by a charity or your kids or your grandkids or anybody else in your family, maybe it's not going to make sense to have such a heavy weighting in bonds. But also, it really should depend on your individual risk tolerance in your actual goals. Don't base on any sort of rule of thumb. No asset allocation should be based on any sort of general rule of thumb. That kind of brings us to the next one. Limit your withdrawals to 4% or 5% a year from your portfolio when you retire. This goes back to the 4% rule. I've seen so many different articles on, is the 4% rule still relevant? I've seen it as low as 3. I've seen it as high as 6. So what should you be doing? Should you stick to the 4% rule? No, you should base your income and your withdrawals on your lifestyle. If you need more money early on in retirement, earmark that, plan that out, put that in your financial plan. Just know that at some point you're going to have to reduce that, if you want to make sure that your portfolio is going to be there for you. There is no one size fits all. So you have to be flexible if you do want to spend more. And that's where, if you want that consistency of every single year you're spending the exact same amount and you're getting the exact same amount, well, then you're going to need to make sure that, you are sticking to something that is long-term sustainable, because there are going to be years where the market's down. There's going to be years where it might not make sense to take such a high rate of, withdrawal from your portfolio. So just make sure that if you're taking more than these general rules of thumb, do it in conjunction with financial planning. Make sure that you're planning every single quarter, every single year. You're at least coming back to it and you're creating a routine around that. Retirement planning, this isn't like a will or a trust. This isn't something that, you do one time, you get this little packet, you set it and forget it, and you put it in a drawer where nobody ever sees it. This is something that you're supposed to keep coming back to, especially as you're retired, so that am I taking too much out? Can I take more out? Can I live off more money? Where do I actually stand? There's so many different ways to look at it, but thinking about it as doing all the planning before retirement and then never coming back to it, that's the cause of surprises in retirement. And I've always said the last thing you want in retirement is a surprise. It's just not something fun that you ever want to deal with. And the next one is, should you have your, and this one, these aren't on that article. These are ones that I have heard of and thought of, and the people have brought to me that, you have to have your mortgage paid off just, to retire. It's just not the case. Yeah. Is it nice? Is it nice to have no mortgage when you retire? It's help reduce expenses, make retirement more sustainable? Absolutely. But I see dozens and dozens and dozens of people every single year that have a mortgage and retire. It's just all about creating the worst thing that we all want to talk about, which is a budget, and making sure that as long as it fits into that lifestyle, and you understand that, then that's okay. So, don't think that you can't retire just because you have a mortgage. And if you've ever wondered, okay, well, I have a mortgage, but I really like to retire. run a plan, see if it's possible. Have you ever gone through that exercise? That's the part of you're trying to figure this out and plan that is most important. And so, and like I said before, we can absolutely help with that. We can do an analysis for you. There's a link in the description below. It's that get started link. Be happy to start that process, just showing you what's possible for retirement. That's really where most people need to start, is just figuring out what kind of lifestyle is possible. I've got all this savings. I've got these accounts everywhere. I've got these income streams. I got hopefully Social Security, as long as it doesn't go bankrupt. That's a joke if you've ever listened to this channel. All these different income streams. What's possible? What kind of income could I realistically get? And then from there, your lifestyle is going to be able to dictate whether or not that's sufficient enough for you to live your lifestyle. So, go through that planning process first. The next one, oh, this is one of my favorites. I see this all over the place. Just Google top retirement mistakes. I would bet that one of them, they're going to have these lists. There's going to be all these different, these different articles out there. I think I've even wrote an article about the top risks that are out there for retirement, and always somewhere always says you have to delay Social Security as long as possible. You take it at 70. You have to take it at 70, because if you don't take it at 70, you're missing out on, this, increased life expectancy because of medicine and the higher benefits. And, if you've got a spouse, you've got spousal planning in there. So really think about it as a joint decision. And all of that makes sense, 100%. But what that fails to think about is the mental aspect of delaying, because there's a mental component to this. There's a thought process. And I had a client once tell me that he had a lot of assets within a tax deferred retirement account. It's like a 401k. And every time he took money out, he had to pay taxes on it, because, for a long period of time, the Roth wasn't as prevalent. So thinking about a Roth, it was kind of a newer thing. So he didn't have much in a Roth. So every time he's got to take a distribution, it stresses him out, because he's got to pay taxes on it. And it's just, you have to gross it up by the tax amount. And it just was a mental barrier that was hard for him to overcome. And so the payoff, the trade-off was, well, if you start your Social Security, you could delay taking money out. You'll have enough within guaranteed income streams of pension and Social Security and other investments that you don't have to touch your 401k until the government tells you for required minimum distributions. So you have to think about and quantify how much of a mental anguish is it every single time to take the money out of the portfolio and have to pay taxes and go through that exercise of feeling stressed out every single distribution, versus the right number on paper. On paper, if you live till a certain age, it's going to tell you delay till 70. But is that the case? If it's so stressful every single quarter until you get to 70 that you have to deal with that, what's the payoff there? The way I phrased it to him was, how much would you be willing to pay to alleviate that stress? There's a cost, there's a price for everything. So how much would you pay? Is it $500 a month? Is it 200? What's that number? Because then you can quantify it. If you say, you know what, if I don't ever have to stress again about anything, and I just had to write a check for $1,000 a month, sign me up. I know I'd pay that. And I don't really think the number was that high. So, it just because you see it listed somewhere on some website, do the numbers yourself. And, always remember, there's a right answer based on the textbook, and there's a right answer for you. There's not one that fits everybody. So that one kind of fires me up a little bit, because I think people should focus on their own plan and not some list that's out there. The next one, 401k loans, is just me paying myself back. It's a good thing. I'm paying myself the interest. I'm investing in me. No, that's not the case. Yes, you're right, but no, because you're giving up and you're not thinking about the opportunity cost of that money. Most 401ks, when you take a loan, they shift that money from an investment into a loan fund. And so you're taking it out of the market. You're avoiding, any sort of, long-term growth with those dollars. So let's just say that the payout or payoff was 4 years. Well, that money is sitting in some loan fund for 4 years. And so, it's not in the market. It's not an investment, and it's, going to miss out on any sort of growth if there is any. And at the same time, the money that you're paying back, so that interest part of it and that payment, if you took that money and you actually invested the repayment part of it, now you're talking about an opportunity cost of the growth on money that was just going back into your account that should be going to possible growth as well. I know, I always say loans and cashing out your 401k, that should be the choice of last resistance, but they're there for a reason. They're a tool that you can utilize, and most people, hopefully utilize them for the right reasons, but don't think of it as this is a good investment choice, because it's not. And that's where that statement, 401k loan is me paying myself back. That's typically what that is. That's just our way, or when I say our, the borrower's way of justifying, here's the reason why I'm doing something that's not necessarily the best thing for my financial health. So those are the different myths that, between Morningstar, between myself, those are some of the ones that you should avoid, at least in my opinion. But I'll base everything off your own retirement plan. Let's switch gears. Let's talk about this fiduciary rule. What is a fiduciary? This phrase, this word is thrown around quite a bit, especially over the last couple of years. There was an article in the Wall Street Journal that talked about how it was titled. Let me scroll down here so we can actually see the article. The insurance industry is winning a fight to kill new protections for retirement savers. So what is this? What does this mean? If you're saving in a 401k or a 403b or anything that is governed by ERISA, that they have, the Department of Labor came out a few years ago with what's called the fiduciary standard. What that meant is that when you're receiving advice to move the money outside of your 401k into any sort of IRA or investment vehicle, that the person, so the advisor that you're working with, they have to act in a fiduciary capacity. So what exactly is a fiduciary? And that is the question of the day. What is a fiduciary, and why does this matter to you? And so when we think about what a fiduciary is, so a fiduciary, there's two types of standards within financial services. For the longest time, there was the suitability standard. Now, the suitability standard, that was saying that a recommendation has to just be suitable for a client. It just has to be suitable. As long as it can be justified that this is suitable, that was an okay standard. And then the fiduciary standard, this is giving advice or recommendations that's in the client's best interest. So now you have to deliver advice that's in the best interest of the client. And so the Labor Department rule would require advisors on IRAs to recommend what's in the best interest for the saver and avoid any sort of misrepresentations or excessive charges. And really where this comes into play is around 401k recommendations to roll money out of the 401k into an IRA. Now, it's really prevalent, especially when people leave their job. When you leave your employer and you go to another job, you have options, and you've got 4 different options. We'll kind of jump to those in a minute, but really this rule, why it's around is because it's to really reduce and kind of curb the commissions on annuities. Annuities are the highest commissionable product within the financial service industry, and they're sold as a way to convert a 401k or a lump sum of savings into a guaranteed income stream. And over the past number of years, annuity sales have just skyrocketed. And it's not saying that they're a bad thing, and a lot of my guess is a lot of insurance salesmen who sell these are talking about, the fact that pensions are no longer available. You're going to build your own pension. And, on the opposite side, they come with very heavy fees, and they lock in, most of the time, they will lock in your money. And so let's talk about the rollover options first. So what are your options when you have a 401k and you are thinking about rolling those over, or you left your job, or you retired? All right. So your first option is you can stay in your 401k. You can keep the money in there as long as it meets the minimum amount that's required within that 401k. You can keep it there. You can stay invested. Sometimes there's additional administrative fees that you might face, especially if you're no longer employed, because often the employer will pick up some of the administrative costs. So you might face some of those, but you can always stay in the plan. There's no rule saying you have to move your money. If you're going to another job, the second option is you can move your money to that new job. This is called a rollover. There's no taxes. This is not a taxable event, so you're not taking the money as a payment to you. You're going from institution to institution, and it's going to stay, if it's a traditional 401k, it's going to stay in that tax-deferred structure. So you're not, subject to the 10% rule penalty. You're not paying income tax on this maneuver. It's just moving it from one company to another. The next one is you can roll the money from a 401k to an IRA. And this is really where this rule comes into play. A lot of the reasons why you would do this is to either work with a financial professional or access investments that you just don't have within a 401k. A lot of 401ks have typically less than, I think it's 12 to 13 funds is kind of the average. And the reality is the reason why they do that is because what they found is that the more options that are given, the less likely people are to actually choose any option. And the worst thing that you could do, kind of touched on this last week, was put money into a 401k or an IRA and just have it sit there in cash. So when you move it into an IRA, there's so many different investments you can get, but that also leads to the opportunity for someone to sell an annuity at a very high commission rate. And so the last option you have with your 401k, if you were to leave an employer, you want to do something with it, if you had a 401k, is that you could cash it out. Now, cashing it out, obviously, this is number 4 on the list for a reason, because if it's a traditional 401k, you're going to be subject to income tax. If you're under 59.5, you'll be hit with the 10% penalty. And so, cashing it out, probably the worst out of the 4 choices. But the other 3, all viable choices that really should be based on what your individual goals are. But where this rule really stems is on the annuity side. So let's talk about annuities for a second. There are such a polarizing investment vehicle. Some believe that they are the best thing ever. Some believe they are, the worst thing ever. Where do they stand? Are annuities good? Are they bad? Well, when you think about any sort of investment for anything, you never want to put all of your money into one investment strategy. That doesn't necessarily mean one account. It's okay to have a consolidated account. It's just one investment strategy. But the reality is with annuities, they come with high fees. They're, like I said, the highest commissionable product in the financial services industry. And so where that comes from is a lack of liquidity. Yes, there are benefits like guaranteed income. And if that fits within your retirement plan and it's going to help you sleep at night, then okay. But where annuities get lost is the people sometimes that are often selling them are selling them as these growth vehicles. So you can get, this unencumbered growth to the of the markets. You can participate in the markets and there's no downside. Well, there's no investment that's too good to be true. You're giving up something. And usually in annuities, you're giving up liquidity and you're giving up upside potential. And so I always say, if you're ever considering an annuity, the first thing you should do, run your retirement plan with the annuity in it and run it without, and compare them side by side. What function and where does this annuity actually sit within your retirement plan? What purpose is it serving? Everything's got a purpose. If you have a growth fund in your investments, that's serving a purpose of growth. If you have a bond, it's serving a purpose of likely income or volatility control. So every investment you have should serve some sort of purpose. Think about it when you're investing in an annuity. I always like to say annuities are like tanks. They are sturdy. They've got all these guarantees wrapped around them because they're insurance products. But how many tanks do you actually see driving down the freeway? Very few. They're meant for a very specific thing. That's what annuities are for. And every single annuity, by every single provider is different in some way. And I've seen it from time to time. if you buy an annuity today and you try to remember all the features and benefits in 5 years from now, it's very hard to do so. It's like asking, what are all the features and benefits on a 2007, Toyota Camry? My guess is that I think AM FM radio. I'm pretty sure that it was had automatic windows. I couldn't tell you all the features and benefits that were sold with that car. Same thing with an annuity. Very rarely are all the benefits remembered of why this fit into the retirement plan. So if you're going to think about buying one, go through and do that, financial planning part of it first, because that's going to be the most important part. I on that note, on kind of the insurance note, I saw this article and it was, why are TikTok influencers pushing life insurance over 401ks? Now, if you're watching this, and you're focused on retirement, my hunch would say you're probably not on TikTok, but this content is likely to make its way to Instagram and to Facebook, where I know a lot of people that are focused on retirement spend their time if you're on social media. And there's this push out there that 401ks are bad, that you have to become your own bank, and you've got to be the one that's, that is, this is how rich people do it. If you ever hear somebody say, this is how rich people do it, that's not how rich people do it. And the problem with things like this is that the people that are offering this type of advice, they're not licensed. It's a lot easier to get your insurance license than it is to get your securities license. So you can sell insurance products all the time, but you have to be, registered with the SEC and FINRA if you're going to sell any sort of brokerage products. And so that's the issue, is that it makes it very easy to go online and post a video and say whatever you want to say, because those individuals, they're not regulated. Whatever I say in this stream right here is going to my compliance after this and before this, and they've got to make sure and review it and hold it for a number of years in retention, because there are requirements as a registered individual. And these people online, they could say whatever they want, and there's no recourse. They can, promote things as, better than a 401k, and there's no recourse. And so when you think about, what they talk about here, so, this is my favorite part. Always follow the money. It goes back to the annuity side of things. Insurance and annuities, because annuities are technically insurance, they're high fee producing investments. So if you're the person selling them, they're very lucrative. So follow the money. If you're investing in a 401k and someone's telling you, well, stop that 401k investment, invest over here. Well, why? What does it mean for me? And what does it mean for you, the person selling this to me? And because, this article really lays it out great, because it's apples and oranges when you're comparing the two. When you think about a 401k, that is long-term savings for retirement. That's not, some sort of product that you have to take withdrawals from, as the policy holder, and, try to become your own bank, as they'll say. 401ks, they're easy to contribute to. They're there for a reason, and there's a reason why there's trillions of dollars within 401k plans. I can't say the same for people treating insurance products like a retirement savings vehicle, and there's not trillions of dollars within those within that. So take a look at this article, because if you've ever heard any of these these comments about how a life insurance can give you some sort of cash value, low volatility, decent returns, and they try to, you're going to probably hear a lot about this, especially when the market pulls back. Anytime there's volatility, well, my insurance policy didn't lose anything. It was guaranteed. Well, yeah, of course, it's insurance. But it's the upside. If you're in your 20s and 30s and you're investing for when you're in your 60s, well, you want something that's going to be long-term. That means that there's going to be volatility, but studies have shown there's never been a rolling 20-year period in the stock market that's had a negative rate of return. There's been some rolling 5 years. There's been some rolling 10 years. There's never been a rolling 20-year period. So if you've got a time horizon like that, it's easy to think about, where your dollars are going now and how do you make the most out of those long term. So This is a really good article. Like I said, check this out in the description below, because it's very helpful when it comes to thinking about why should you be investing in 401k. If you've seen some of these videos, insurance in itself can get very, very complicated, and it can sound amazing. And that's the hard part, is that insurance products sound so good. They make it sound really appealing. And if finance is not your thing, and you're focused on your career as an engineer or a doctor or whatever you do, and you're not thinking about what's going on in the stock market from day to day, and you're just worried about your family, your job, your long-term career success, and this isn't what you do every single day, and you hear these really good stories around how you can invest in this amazing product that gives you zero downside and all this upside potential, just know there is no magic bullet. There's no perfect investment that's going to give you all the upside with no downside. There's always a trade-off there. And anytime that we're talking about anything insurance related, always remember that the person selling it to you is going to be benefiting quite a bit. And if you're okay with that, that's fine. Hey, we all buy insurance through someone, right? That's okay. As long as you've done the planning part of it first, as long as you've ran it through your retirement plan and you are very aware of how those monies fit within your long-term financial plan, go ahead, buy whatever you want. Let that salesperson sell you whatever they want. But if you haven't, don't buy anything without actually planning it out first. Just because a sales brochure looks really good, just because a sales pitch sounds really good, just remember, highest commissionable products in the entire financial services industry, offered by a lot of people who are not securities registered and can say whatever they want. Like I said, after this, compliance gets to watch this, and they get to determine and make sure that they hold on to this recording for a number of years, because we're registered, and that's the difference. So when we're thinking about retirement, it always comes back to your plan, and make sure that you've gone through all the steps needed to plan for your individual retirement. Don't listen to general rules of thumb, especially the closer you get to retirement. Generalities, just throw them out the window, because you want to make sure that everything that you're doing, from your savings rate to how much you're going to be taking in retirement to how you're investing, all that stuff needs to be customized to you. So this was fun. Hey, next week I'll see you, and we're going to be 1 week closer to football, so I'm excited for that. Every Tuesday at 4 p.m. Central Time. Make sure, if you have questions about your retirement, use that link in the description below. Schedule some time with a member of our team. We'll go through a complete complimentary retirement analysis for you. There's no cost to doing that. Let's spend some time. Let's help answer your questions. Our goal here at the Think Retirement channel is to just put out information on retirement, and we're going to do that on a weekly basis. So thank you so much for being here. Thanks for watching, and I will see you all next week.